Good morning and thank you for joining. Today we have a very special webinar for you all, which should better help you understand the Roth conversion strategy. And if you've been on any of my past webinars, you have probably already heard me mention Roth conversions, but I generally just touch on them and don't go into too much detail. And after reading many of the comments in our surveys requesting that we create a webinar that fully focuses on this strategy, we decided to do it. So here we are today. And today, what we'll be doing is reviewing the details of Roth conversions, from the basics to the more specific information, hopefully giving you all the ammunition you'll need to properly follow this strategy at some point in your life. And what I want everyone to understand is this strategy can really be used for anyone. There's no age limit to when it is best executed, minimum limitations set by the IRS surrounding the conversions. And overall, it's not too complex to do. But there's a lot that goes into the proper execution of this strategy. So, with all that being said, let me give you an overview of my team and what we do before getting into today's content. And I do want to mention that any strategy that's related to tax should be reviewed with your CPA or tax advisor just to ensure it fits with your unique and holistic situation. But on to us. We're a boutique wealth management and financial planning firm here in beautiful Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, many of which are on the line today, is work with them on their holistic financial planning and investment management needs. We found that our industry is just too focused on just the investment side of planning. So we've made it a priority to take both a comprehensive and a holistic approach and to continuously educate, which is one of the reasons why we host these webinars. And our process involves building well-designed financial plans, organizing our clients' investments in coordination with their plan, and then just ensuring that any outside planning items have been handled, which may or may not involve our collaboration with outside professionals like attorneys, CPAs, or just anyone within our client's advisory team. And here's a quick overview of our team. And with our firm, we have 7 planners, myself included, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's get into today's topic. And shown here is what we call the planning pyramid, which are many of the areas that we talk to our clients about when building out a financial plan. And generally speaking, the more of these boxes you can check off, the more secured your planning may be. And for today's conversation, we'll be specifically touching on that tax aspect of planning, as well as retirement planning, because they kind of go hand in hand with this strategy. And for today's agenda, we're going to first do a quick review of IRA accounts in general, because you need to understand those types of accounts before understanding this specific strategy. We're going to review something called the Roth conversion ladder, which can help save in tax when implemented correctly. And lastly, I'm going to review some specific examples so you can understand the details to these conversions in as much detail as possible. And the first thing that everyone should be aware of are the logistics to both the traditional individual retirement account, or just IRA for short, and the logistics to a Roth-based IRA account, because both are involved with the execution of this conversion. And both IRAs and Roth IRAs are considered investment vehicles. They are not the specific investment like a stock or like a bond, but they're the vehicle that you place those investments within. And generally speaking, you use traditional IRAs and Roth IRAs to invest because they have favorable tax treatment. For example, within a traditional IRA, typically the amount of money that you contribute to the account actually results in a tax break for you via a tax deduction the year that you make the contribution. And because you received a tax deduction by contributing those funds, you'll eventually have to pay tax when you distribute, and that's usually in retirement. With a Roth IRA, it's sort of the opposite. When you put money into the account, you do not receive a tax deduction, but all that money in the account grows tax-free forever. And ultimately, when you pull the funds out of the investment vehicle, you'll never have to pay tax again. So long, of course, that it's a qualified distribution, which means that it occurs after the age of 59 and a half and you have had your account for over 5 years. So you could consider a traditional IRA account a pre-taxed investment vehicle and a Roth IRA account a post-taxed investment vehicle. And generally speaking, people tend to like traditional IRAs when they're in a high tax bracket because making those contributions and receiving the tax write-off is a fairly nice benefit because you're saving a good amount in tax when you might be paying a lot. And people generally like Roth IRAs when you're in a lower tax bracket because while you still have to pay a little bit in tax, they're ultimately avoiding a lot of those future taxes, which eventually would come potentially at retirement, which can be a huge benefit in the long run. And traditional IRAs and Roth IRAs both have income limitations, kind of restricting certain individuals from contributing money into them. But what is important to know about conversions are that they're not the same as a contribution, which has those limitations. For example, if you make over a certain amount of money, you are not allowed to make the $6,500 per year 2023 contribution to a Roth IRA. However, you are still allowed to convert money from your traditional IRA to your Roth IRA, and you can convert as little or as much as you'd like. There's essentially no cap to it, unlike the contribution limits that I spoke of earlier. So that is the first point that I want everyone to be aware of. Conversions, which are today's topic, do not have those restrictions associated with them in regard to how much you earn disallowing you to convert. Does that make sense? We're going to get into the specifics shortly, so let's just move on to the next slide. So we've already reviewed the top section here. So let's just jump into how to properly execute a conversion. And the first step generally is to have money in a traditional IRA. Now, once again, a traditional IRA is one of those types of pre-taxed investment vehicles. You could also have money in a 401k, 403b, or some other type of pre-tax retirement account. And while you technically could do the conversions directly from those accounts into a Roth IRA, my recommendation would be to generally move your non-active retirement plans or non-active employer plans into a traditional IRA, and then begin the Roth conversion process from there. And when I say non-active, all I mean that it's a plan that you no longer use with your current employer, so it's a past employer retirement plan. And that leads me to the second step, which is then opening a Roth IRA account, typically at the same financial institution where your traditional IRA is held. And the reason that I specify that you use the same institution is by doing so makes this whole process a lot easier on your end. The third step is moving money from the traditional IRA to the Roth IRA via a conversion. When you do this, there are essentially two things that you need to know in advance. One, how much money do you want to convert? And two, how much tax do you want to be withheld from the conversion? We'll talk about both of these factors later on, but before converting, you will want to have those questions answered. Now, once you have converted the funds, those assets are in an after-tax retirement account. So they're going to grow tax-free for you essentially indefinitely. There's one nuance that you should be aware of, which is you do have to wait at least 5 years to withdraw any money that you converted. But it's fairly rare that someone is going to want to use this strategy and then take the money out because it's usually best to just allow those funds to grow. And then the last step, in some way you do have to pay tax on the conversions. So by converting, what you're essentially doing is moving pre-tax money to a post-tax account, and that results in income taxes. Every dollar that you convert is $1 added to your adjusted gross income for that calendar year. So if you've made, let's say, $50,000 and you converted another $50,000 to a Roth IRA, your AGI, your adjusted gross income for that year, would be about $100,000, and you'd have to pay taxes according to that income level. Now, there is a bit of a strategy around when and where to pay the taxes from, as you do have options. But I'll save that until we review specifically who these conversions are good for, excuse me. So let's just go to the next slide, and we'll come back to the tax in a little bit. And the simple answer to the question of who these are good for is conversions are generally good for those who believe they're in a lower tax bracket today than they will be in at a much later date, generally speaking, retirement. Think about it. If you're in a low tax bracket today, maybe you're taking some time off work, maybe you're starting a business and have very little income, and you expect that in retirement you will have plenty of income sources. Let's say Social Security, IRA distributions, dividends, interest, maybe a pension. Well, wouldn't it make sense to pay the tax today on some of your IRA funds and move those funds into a vehicle that have no tax upon distribution? But to help you understand it, let me show you a specific example. Let's just say this hypothetical person here has a $60,000 IRA account. And they're a smart investor, and they let that money grow through the years. And maybe over a 10-year period, it doubles, 100% return over 10 years, resulting in an account value of $120,000. But you should know that because it's in an IRA and it hasn't been taxed yet, it isn't truly worth $120,000 because taxes are still owed upon whatever distributions you take from it. So let's say now this individual is, let's just say, in a 30% effective tax bracket for the remainder of their retirement. So we could safely assume that the true value of that IRA account isn't $120,000. After tax, it'd be more like $84,000. Does this make sense? IRA accounts are generally worth less than their account balance due to the fact that you still need to pay tax. But let's change the scenario now then. Let's say that in this example, this individual converted the $60,000 today rather than letting it grow in a pre-tax retirement account for the next decade. And in this example, let's just say their tax bracket is only 15% today, which would leave after the conversion $51,000 in their Roth IRA. Now, over a 10-year period, this money is still invested and growing for him. But the difference is now the dollar amount he sees in the account is truly the value he owns, as no more taxes needed to be paid. And after 10 years, the true value of his account would be, let's say, $102,000. Once again, still 100% return over 10 years. So in summary here, this individual benefited about $18,000 through converting IRA funds while in a lower tax bracket. And to go full circle back to what I said at the beginning of the slide, these conversions are essentially good for those that are in a lower tax bracket today and believe they will be in a higher tax bracket in years to come and maybe in retirement. Now, I'll talk about how to figure out where you want to pay the tax from and how you'll do it. But now I want to go back to what I first had mentioned in the last slide about where should you pay the tax, because that can drastically change the amount of retirement funds you have. And you have essentially two options of where you can pay your taxes from when you convert. You could pay them using the funds that you're converting, or you could pay with cash on hand. So let's start with paying with your IRA funds. Essentially what this is an option that allows you to withhold the tax as a part of the conversion. Most financial institutions have a spot within the conversion paperwork that would have you elect how much federal and how much state tax you want to withhold. And what happens is that money is actually taken from your IRAs as you're converting, resulting in less money now transferred to your Roth IRA. It's kind of like when you get a paycheck and there's already money taken out, both federal and state. So let's say you converted $50,000 and withheld 20% in tax, then only $40,000 would be deposited into your Roth IRA after the conversion. The benefit to this is that it doesn't require any additional taxes to be paid after the conversion if you did it correctly. Many people may not have the cash on hand or on hand when they file their taxes to pay a big tax bill, so they elect to withhold tax from the conversion. You're essentially setting yourself up well to not have a large tax bill at a later date or to prepay your taxes via quarterly estimated tax payments. The largest negative to this strategy, though, is that you're essentially lowering the value of your Roth IRA holdings. For example, by moving $10,000 from a pre-tax retirement account to a post-tax, and then just paying the taxes owed at a later date when you file, you're essentially increasing the amount of money you have in your retirement savings. Because as we know, $10,000 in an IRA is generally worth less than $10,000 in a Roth. Additionally, if you overestimate your taxes, there's no easy way to get that money back into your account. You would just get a tax return, you'd get money back on your tax return. So you would essentially have reduced your retirement savings for no specific reason. So that leads me to the second option, which is paying the tax on hand, or paying tax with the cash that you have on hand. And what this means is when you convert, you elect to withhold no taxes. What will happen is when you file your tax return the following year, you'll report that conversion and you'll report that you paid no tax on it. And essentially, what will happen is the IRS will include this conversion within your collective AGI, calculate how much taxes are owed, and then you'll just pay the taxes when you'll file. And if you were listening to me a minute earlier, you know that the main benefits to this is that it increases the true value of your IRA holdings. When I've personally done these conversions, I've always just paid the tax with cash as I want to increase my retirement savings as much as possible. But of course, you do need the cash available. So if you're making a hefty conversion, I don't think you want to have that big tax bill out of the blue when Uncle Sam comes a knocking. So my recommendation is to plan for it. If you don't think you'll have the cash on hand, to use money from the conversion. And then also if you're doing a large conversion, you might also need to pay estimated taxes in advance to avoid an IRS penalty. So just make sure you're talking with a CPA or a tax advisor so you don't get hit with some large tax bill or some fees that you just weren't expecting. But now we've discussed the logistics of the converting and exactly who they're good for. But what I want to do next is discuss an ongoing strategy that many people utilize, and it's called the Roth conversion ladder. And what this strategy involves is regularly converting each year due to being in a low tax bracket. Typically, this is because of retirement, but this strategy could really be geared to anyone if you're continuously in a low tax bracket. Now, if this is you, or if this is not you, don't zone out because this concept may make sense for you at some point down the road, and it still plays into many other scenarios involved with conversion. So let's just start with the first step. And the first step, as always, is to have some money in a pre-tax retirement account. Now, this strategy involves converting every year. So the goal is to keep your income low during the years that you convert. And this can be done if, for example, you're retired, you hold off claiming Social Security, and then let's say you utilize other non-retirement assets to pay your day-to-day expenses. And while you're in those low income years, that is when you would most likely want to move your pre-tax retirement funds into one IRA for ease of management, of course, and then to slowly begin converting from your traditional IRA to your Roth IRA over the years. Now, we'll talk about figuring out how exactly and how much to convert shortly. But what is important to make this strategy work is, once again, keeping your income low. There are many things that increase your income: earned wages, Social Security benefits, pension benefits, IRA distributions, capital gains, dividends, interest, and more, all add to your AGI. So when you're executing these conversions, it's best to have a handle on your collective income and to do your very best to keep those income sources from resulting in more tax. Now, the second to last step, as I've already mentioned, is that you do have to wait at least 5 years before you can use those converted funds, even if you're 59 and a half. And then lastly, you get to withdraw this money completely tax-free so long as it's a qualified distribution. Now, this strategy is generally best for those that have just retired, but like I mentioned, it can really apply to anyone. Let me give you a very specific example. Maybe you're an executive who's been earning a hefty $250,000 income for years, and you've been maxing out your 401k plan each year. And then you decide to quit and start your own business. Well, as most people on this call know who manage their own business, businesses usually take a couple of years to truly become profitable. So during those years when you're growing that business might be an ideal time for you to do a conversion ladder. Another example would be if you decided to take a few years off of work. I know people that have saved for years to spend maybe 2 or 3 years overseas on a temporary break from work. And if that's you, then don't forget about this strategy, because that might be an ideal situation to convert. But anyway, we're coming up on the last few slides, and before closing out, there is one big concept that you do need to understand before I finish here. And most of you probably already understand this, but many people that I've talked to don't. So I really want to spend some time discussing it. And what I have mentioned is that every dollar you convert is added to your adjusted gross income for the year. And your tax bracket is calculated based off of your AGI. So what that means is if you're in a low tax bracket and then you convert, your AGI will increase. I knew a guy who was in a low AGI, so he decided to do a $500,000 IRA conversion in 1 year, thinking that he was going to pay tax at a tax rate that he was currently at before he did the conversion. But what he didn't realize was by doing such a large conversion, he bumped himself into a very high tax rate and paid almost $200,000 in tax on that conversion. This is critical to understand. So take a peek at the example. This individual has a lot of various income sources. They have $30,000 of earned income through their work. They have $10,000 of dividends from stocks. They have non-retirement accounts, so they have $5,000 of bond interest along with $5,000 of capital gains. All in all, that means they'd have an AGI of around $50,000 prior to doing their conversions. Now, earning $50,000 would result in a fairly attractive tax bracket if you're single or even if you're married and filing jointly, and and even more if you have a lot of write-offs and deductions. So if in this example they converted, let's say $50,000, that amount would get added to their AGI, resulting in $100,000 of taxable income for the calendar year, and they of course would be taxed appropriately. So this concept now leads me to the last section of the webinar, which is how much should you be converting? And the answer to the question is not very black and white. So to fully understand it, what you're going to need to do is some base financial modeling around your own financial picture. So take a look at this hypothetical model that I built out. This is the type of modeling that's exactly what we do with our clients to help them make smart financial decisions today that are going to benefit them in the future. And what is shown here is just one aspect of the modeling, and it shows two things: the balance sheet under the asset section and the various income sources under the annual income sources section. So with this couple, what you can see on the left-hand side is after they retire at age 65 and 66, they have a fairly hefty retirement savings, as well as a pretty high net worth, and that they don't really have much income from 2032 to 2036. You can see that at the bottom of your screen. That's where the projected income is. Now take a look at the right-hand side of the cash flow projection. By 2037, they both are pulling Social Security, adding approximately $91,000 to their yearly income. And by 2039, they're both taking required minimum distributions from their retirement accounts. So you'll see that their income is projected to be about $125,000 in retirement, which is actually a good amount, especially when you compare this to years 2032 to 2036, when their income was essentially nothing. So what does this mean for the couple then? Well, this type of modeling is exactly what shows them the general idea and the general concept behind how much you should be converting. For example, in 2032, if they just converted $1, they'd probably be benefiting. If they converted $125,000, similar to how much income they'd have at retirement, then they probably wouldn't benefit all that much from it because they would just be paying the same amount of tax as they pay in the future. So the range of this conversion would probably be somewhere between $1 to $125,000 in my eye. Now, once again, there's no exact science to determining the exact amount to convert. But once you have your range, my recommendation and many advisors' recommendation would be to convert the amount kind of right in the middle of that range. For example, this individual may want to convert about $60,000. The reason for that is that if you decide to convert too close to the end of your range, in this example, 125, you're not really gaining all that many tax benefits. And if you converted close to nothing, then you're missing out on some significant benefits. Now, once again, this is just a rule of thumb that I follow and many advisors follow. It's not correct for everyone. But with that being said, the best way to determine your range is usually to model out your retirement, just like in this example, and then to come up with a calculated range that would work for your projected income. Simple as that. So with all that being said, let me close with a quick summary. Conversions can take place really at any point, and there are essentially limited restrictions on how you execute them. What you need to understand is that every dollar you convert from your IRA to a Roth is increasing your income for that calendar year, dollar for dollar. Ultimately, the goal of conversions is to complete them in years where you have little to no income, or you're just in a much lower tax bracket than you're planning to be at a later date. And lastly, the best way to get started with these conversions, in my mind, is to build out your long-term financial planning, have visibility into your financial future, and then make decisions based on educated expectations and modeling regarding your financials rather than just random guesses. And if you're a client on the line and any of this has resonated with you, please reach out. These are one of the topics we try to build into our planning sessions when we meet with you, but a lot comes up. So if anything's being missed, don't hesitate to give us a call and set up a meeting. And if you're not a client on the line, all I'll say is reach out to us if you have questions. We'd be happy to give you some advice or potentially talk about what a relationship with our team would look like. So my contact information is on the screen if you'd like to talk. But what I'm going to do now is open it up to questions for those that are on the line. And if you're watching the pre-recorded webinar, we do have to close out before we open it up. So let me close out now. If you have questions, feel free to email me directly. And for those on the line, just hold on for a second and we'll get to questions shortly.